If you're terrified of investing and you have cash sitting under your mattress rotting to inflation, this video is for you. I am an engineer and I have read more than 22 books on money, finance and investing, and I am giving you the crux of my knowledge. This video will explain to you how to open an account for your investments in the cheapest, most sustainable and science-backed way. So first of all, open a Wealthfront account. Now, what is Wealthfront? It is a Roboadvisor. Roboadvisor means nothing but a machine, an algorithm that in this case has used data and science-backed information to create a portfolio that is going to give you the best long-term returns. And by best long-term returns, nothing is guaranteed, but what science has shown is the modern portfolio theory, which means your portfolio has some stocks, some bonds, some cash. This is the type of portfolio that will give you a long-term chance of success. So we're not talking about making money quick here. We're not talking about anything scammy. It's something that you do with all the spare money you have. You put it in this portfolio and let it grow, let it ride with the market. I'm a big fan of DIY investing and I love to buy all the index funds and bonds myself. But I also, after knowing all of this, find myself not rebalancing my portfolio. And by rebalancing, what I mean is that stocks and bonds, give or take, go opposite directions. So when stocks are going higher, bonds usually go down, and when bonds are going higher, stocks go down. It's not a one-on-one correlation, but that discussion is out of the scope of this video. Just understand that you need some stocks exposure, some bonds exposure to keep your portfolio into kind of an equilibrium state. And that exactly is what is rebalancing. And how you can do it yourself is when you buy index funds that track stocks and index funds that track bonds. When stocks go up too much, you sell some of those stocks and buy some bonds to keep the percentages of stocks. Say you chose 70% stocks, 30% bonds. You're going to keep that ratio by buying and selling these two categories of investments. But here's the kicker. Nobody does that. Everybody in theory says, oh, once every year, maybe on your birthday, sit down and rebalance your portfolio. I swear I haven't done it in the last 5 years. So I just love the convenience of this Roboadvisor for a much lower price than what you would pay to some asset manager. Whenever there's too much human involvement in your money portfolio, you end up paying extra price for that. And that's what this company is here to close, that market gap. That if machines and algorithms can do this work for you for way cheaper, then you don't have to hire an asset manager. What Wealthfront does is it will buy Vanguard index funds and bonds in your portfolio in a certain percentage and then keep rebalancing it based on how the stocks and bonds are performing, based on some algorithms, to keep your tax liabilities the lowest, but still give you a portfolio that has proper exposure based on your risk tolerance. Usually, if you are younger, your risk tolerance is higher and you'll have more stocks in your portfolio. But when you get much older, you want a larger exposure of bonds because you're about to retire and you want some stability and you don't want the wild ups and downs of the stock market affecting your portfolio. And that's why it's really cool that Wealthfront can do this for you for a very nominal fees, because if you were to buy most of these Vanguard funds by yourself, you'll be paying anywhere from 0.04 to 0.15% expense ratio. Expense ratio is nothing but the price that you pay to keep this fund. So in context, 0.04% is $4 for every $10,000 you have invested. It's pennies on the dollar. But Wealthfront charges 0.25% for all the balancing and tax loss harvesting that they do. This extra fees is worth it because you'll be saving on taxes. Now, I have mentioned tax loss harvesting a couple of times, so let me just explain what that is. Tax loss harvesting is easy if you think about it. Whenever you have losses in your portfolio, you can sell those funds, right? Say you bought funds for $1,000 and you had a loss of about $100, so now you have $900 worth of those stocks. If you sell this $900, you can book a $100 loss, and during the tax return time, you can say that, oh, I had this $100 loss, and what the IRS gives to us in the United States is $3,000 worth of capital gain or ordinary income can be offset against that loss. But here's the thing. We also want to stay in the market. I can't just sell this $900 worth of index funds and keep it in cash. This $900 has to still stay in the market and give me the same growth and risk exposure. So it is much easier for this robo-advisor to figure out the funds that are compatible, because they cannot trigger a wash sale. Just know that there are certain rules that when you sell a certain type of fund, you cannot buy very similar funds to put you back in the market and then book your losses. So again, this gets really complex very quickly, but if you let a robo-advisor do that, they already know all the lists of these funds that are compatible with each other, and whenever you have tiny losses, they will sell, buy something very similar and keep you exposed to the market gains. All the losses that you've taken in this account will be booked against the capital gains that you get at the end of the year. And once you have this, you save about $3,000 every year in taxes. So already, especially for smaller to mid-sized portfolios, the extra fees that they're charging can be offset by these tax loss harvesting methods. Of course, nothing is guaranteed. Not every year will you get benefits. And there is one more benefit that you'll get, where if you open a cash account with them, you get 5.5% interest in today's rate. Especially if you use my link, I'll get an extra 0.5% and you will too. Now that we have all the benefits out of the way, let me show you exactly how to open this account. So once you have my link and you click on it, this is the page that you'll be greeted with. And you can see that you'll get a 5.5% interest on your cash accounts. What I would do is first open the cash account, wire all my credit cards and even my paycheck to this account. So anytime you have cash sitting around, it is earning 5.5% interest as opposed to the meager interest amount of Bank of America, like 0.01%. So once you have this, you get started, open this account. If it's just for you, add your name and continue making the account. It'll ask you your email address and password and all sorts of captcha, and also it'll ask you your phone number for two-factor authentication. Once you have all of that in, you can wire an existing account. So say you have a Chase account, you can log into your Chase account and connect it to Wealthfront. From there, you can move money from the Chase to this cash account and start earning interest. So do that right away after you're done watching this video, and you will get hundreds, if not thousands of dollars every year in extra interest. The account that is the crux of this video is the investing account. So I'll take you over to a snapshot of my account and log in so you can see exactly how to open your investment account. All right, so let's go to Chrome. Go to Wealthfront, log in, open a new account, and the one we want to select is the automated index investing. General investing. To keep this video simple right now, let's just use the Just Me option. Go to Just Me. All you have to do to connect the two accounts is put in the username and password of an already existing account. In this case, assuming it's Bank of America. I have all of this connected already, so I will go to the next step and say we use this account, for example, and it'll ask you how much you want to deposit. So you'll see the minimum is $500, and that it's not that much money to start investing, especially into index funds. Yes, you can buy ETFs for $10, but if you have $500 to spare and you want to invest more and more money, start right over here, because the portfolio rebalancing and tax loss harvesting that you will get with this account. And the best part is you can choose how risky or how safe you want your portfolio to be. So in this example, I'll put $5,000 in there. It hasn't really transferred the $5,000, so don't worry at this step. What you just will be filling is the information about yourself, and now it'll ask you your risk tolerance. Usually this is the screen that will show up first. Because I already had an account, they assumed that I wanted a risk factor of 9 out of 10. So I'll just explain to you what this means. 9 out of 10 means you have 90% stocks. You can see here the percentage of bonds is just 9% and the rest of it is 91% stock. If I want to reduce the risk, say you are about to retire in the next 2 to 3 years. Now, this is the time where you don't want to risk a lot of your cash because you want some cash reserves to start. So you can even put a risk amount of about 5.5. And now see what happens to your stocks versus bonds. The bonds are now 34% and you still have about 65% of stock in there. Having stocks doesn't just mean that your portfolio is going to be very risky. These are not individual stocks. This is not just buying Facebook or Apple. These are index funds, which means you have exposure to thousands of companies. So when an investment platform says it's risky, take it with a grain of salt. I don't think it's very, very risky to have 3,000 companies in my portfolio, because I know that they are not just going to go down to a valuation of 0 anytime soon. What is very risky is buying a single company stock and hoping that this is going to double in no time. That is extremely risky. There have been so many companies that have gone down without a trace instantly. If you want, look up the story of Enron, how so many of their employees had their 401ks, their savings, their future investments in the same company, and they never figured that the company executives were scamming everybody, and one day the whole house of cards came down crumbling and people lost their entire life savings. So buying individual stocks is extremely risky. If you want to do it as a game, use whatever you would spend on a weekend vacation, just that much money buying individual stocks. But when we are doing this, we are buying ETFs, and they will give you so much exposure to the broad market. And that's why, as a younger person, and especially not planning to use any of this money anytime soon, I keep my risk profile to be 9.5, and that way I get a bigger exposure with stocks and my portfolio grows faster. So confirm and continue, and then this is the type of account you will be making, and then you just acknowledge, agree with all their terms and conditions, and open the account. That is the gist of opening an index fund account. I would highly recommend you open both of these accounts today, so you have at least the containers open and your first $500 are invested. I hear these excuses countless number of times by people. I don't have enough money. All I'm doing is making ends meet. Yes, you're making ends meet, but so many people are sporting their Stanley cups, $50 for a water cup. No, that $50 needs to go in your investment account, even though you're trying to make ends meet. So opening these accounts and making investments easy is the first step. If you don't want to use Wealthfront, totally cool, don't use it. I have made a video in the past how to create your own modern portfolio theory portfolio, and I will link that in my description box, so you can go check out how to choose funds and what type of exposure you want, a 3-fund portfolio. And I will also list all my favorite books that I have read about investing, so you can start reading if you're interested and learn and understand these concepts in as much depth as your heart desires. Good luck with investing, and I'll see you in the next one. Bye bye.